Hey guys, happy Thursday. Hope everybody's doing well. There's been a terrible start to the week here on Monday in the markets. And of course, here comes the Fed. So we're going to be talking all things Fed and what to kind of digest out of all the conversation there just yesterday on Wednesday. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And as always, our goal here this week is to kind of boil down the market happenings of the week. Hopefully bring to you the stuff that really matters or that you can kind of implement in your planning strategies and weed out the rest of the noise. Hopefully you're enjoying the fall here. It's actually nice today, but man, this last weekend was pretty dark. I used the weekend to kind of catch up on things as we had a little worse weather. But I missed the sunshine already. I mean, it is dark. In the mornings it's dark for like 2 hours when I get in these days. I missed summer already, but hopefully you're enjoying it. Anyways, we'll get into it here this week. And I want to start off with our crazy Monday that we experienced. So right out of the gate, we had a terrible start to the week after a few weeks actually of kind of slowly peeling off some gains. Monday at the lows, markets were down near 3%. They didn't end up closing that low, but it was a pretty down day. Now we've popped up quite a bit since, but definitely a day of a noteworthy day. Let's put it that way. I'm curious if you were watching this and kind of what your take on why this has happened or what that ripple effect might have been. For those who were following, there's a giant Chinese property developer, Evergreen, I believe is their name, and they may be facing default on some giant loans. And so I think what has happened is obviously there's some concerns about how this relates to the banking relationships and, any other debt holders and how that all plays out. But from my perspective, I think the bigger concern was we've been hearing all about debt levels forever now. And so I think that led to a lot of panic around this, just like now we are hearing about this giant company looking at default. And I think the concern was, well, what about the others? So I'd love to hear your thoughts here, if that's kind of your perspective on this as well, or if you were seeing something else within that Evergreen concern there on Monday. But for my take, that's kind of what I think led to a lot of that. And I think probably the reason we bounced back is because although I totally understand that concern, keep in mind that debt levels are important, but the cost to service that debt a lot of times can be more important. So a lot of, like right now, because interest rates are so low, we have a lot of companies that have kind of leveraged up a little bit more than they might normally because it doesn't cost them a lot to carry it. Now, if that cost goes up, don't get me wrong, we could be, then there are some challenges. In other words, if interest rates go up, as well as, going too far with that, right? We need to be cautious in carrying too much debt too. But that's kind of my take on what happened Monday. Obviously, we've popped back quite a bit since. And part of this was based on Fed comments. So yesterday, Fed Chair Powell had his conference. The gist of it, if you want the 30,000 foot view, no rate change, and they suggested tapering should be looked at soon. So a lot of people are suggesting that they mean coming up in November, basically after next meeting, they'll say they're going to start doing it. What I thought was really interesting is they had said supply constraints were restraining activity, and that basically when supply issues slow, so will inflation. They mentioned that spending has slowed in COVID-sensitive areas, and there's actually some evidence from what I've heard in their beige book kind of suggesting that this inflation thing isn't as transitory as they may be leading us to believe. So, it's really interesting. They say one thing, but on the other hand, there's evidence and maybe some other comments suggesting that this inflation thing may not be transitory at the end of the day, or at least not as transitory as maybe they're leading us to believe. So I think that's important to watch. And the interesting thing is they talk about tapering. So for those who aren't familiar with this, they've been buying a significant amount of bonds for a long time now, basically through this COVID challenge. Tapering basically means that they're going to slow down that bond buying. It doesn't mean they're going to stop, but slow it down. So the interesting thing is that they had suggested that they would like the tapering to conclude around mid-year next year. So that's only, if they start in November, that's only 6-7 months, right? So they're really talking about being pretty aggressive with it. And I think that will be something to watch because they are buying a lot of bonds right now. As far as interest rates goes, Fed Chair Powell had mentioned that they're really looking for max employment and inflation to moderately exceed 2%. We've heard this conversation for a long, long time. However, I think the nuance I picked up in there is that now they're saying they want inflation to moderately exceed 2%. Before, it was that they wanted it to be at 2%. So it's just interesting to watch these conferences and how this kind of evolves over time. I'm very happy to hear that we may be starting the tapering, but it looks like the interest rate conversation is going to be a ways down the road still. One thing that kind of came out of that is when the Fed is buying these assets, there was actually some concern and actually even a question about incentives for Fed decisions and the underlying incentives or trading that's going on with Fed members. Fed Chair Powell actually admitted that he owns some municipal bonds, and the question basically came up, is it okay for the Fed to be buying municipal bonds if a Fed owner, in fact, the president, owns that particular asset? So, it's pretty interesting to hear. I'd love to hear if you guys think that that should be okay, or if that seems like some sort of conflict of interest. But it was interesting to hear it be addressed because it's, that's been the case. He's been buying those bonds for almost, 2 years now. Fast forward to today, that's enough on the Fed talk. Hopefully that gives you a quick idea of where we're at. But again, pay attention, tapering probably starting November, it sounds like. They mentioned that they feel like, a lot of people feel like all the requirements have already been met. And so really all they're looking for is a decent, I think was the term he used, jobs report. I think in other words, what they're saying is they're doing it as long as there's nothing terrible that happens in the coming month. Fast forward to today, we had initial jobless claims come out, and it was another jump this week at 351,000. So not a good trend. Hopefully, again, this is short term, but definitely something to keep an eye on. And then really all week outside of the US, if we start looking internationally, there's been bad news after bad news. Europe is slowing significantly, and really highlights my point from last week that, this overweight to international can get a little tricky. Now, that said, luckily the stocks have not been hit super hard from all this. But as you might imagine, if this slowing in the economy continues, it's very likely that may carry its way over to the equity side of things as well. So something to really pay attention to there, and how that relates to US stock and returns and all that good stuff too. All right, that is a lot for this week, so we'll kind of move on. Coming up next week, though, we've got a lot. We got new home sales, we got consumer confidence, and GDP revision all in 1 week, so we'll have a lot to cover next week as well. And I wanted to make sure to keep some time for our question of the week. So if you guys have a question, please reach out. You can use the hashtag AskBrandon or just send me a message, whatever works best. But if we end up using your question, we'll send you a copy on me for the great feedback and topic to touch on. For this conversation, I want to spend some time talking on potential tax changes for 2022. This has started to pick up a lot more steam here recently as we get closer to year end. If they want to get something through, obviously it's got to start happening here pretty soon, now that we only have about 3 months to go. So I wanted to talk a little bit about what's going on. The first thing I want to mention is that the potential tax changes have significantly changed from the original Biden tax plan. So let's kind of talk about where we're at today, and then we'll talk about some of the other changes. One of the things that they're looking at is potentially increasing the top tax bracket slightly. So I think that was going to go up to 39.6 something, 30. Anyways, with the net interest income, I think it jumps up to about 42 basically. They're also talking about higher tax rates on long-term gains for high income earners. So basically bumping that up from the 20% that it's at now to 25%. They are talking about limiting backdoor Roth opportunities for high earners as well. And also reducing the estate tax exemption. So right now, I think the federal level is about 11.5 million. They're talking about reducing it. I think I've seen something about around half of that, which is a huge, huge decrease. And for those who may find themselves in that particular boat where they may be over that, may provide some incentive to look at some options as we gear up for year end. A lot of tax planning to consider as we find out more here in the coming months. So the last thing as well is that corporate tax rates is part of that equation as well. They're talking about raising it a little less of a rise in the corporate tax rate than the Biden plan, but still looking at raising corporate tax rates as well, minimum corporate tax rates. So again, this is a lot different than the Biden plan. I know originally there was hopes to get rid of the step up in basis, if you're familiar with that, which basically means that when assets pass to the next generation, they would get a step up in their cost basis, and 1031 exchanges, which gave real estate owners the opportunity to move those funds into a new property and continue to defer the taxes. There's a lot more to both of these, but on the high level, that's generally what they do. So it's not to say those may not come back, right? We want to still pay a lot of attention to that, but the tax plan right now is quite a bit different than it was originally when Biden had rolled it out. So again, increasing top tax bracket, increasing capital gains rates on high income earners, limiting backdoor Roth for high income earners, reducing the estate exemption, and then increasing the corporate tax levels. So keep an eye on that. That's going to, I think, pick up a lot more steam. We're going to hear a lot more about it as we gear up for year end. But with that, we'll break. We will see you next week. Again, we got a lot to cover here next week, but definitely reach out if you have a question of the week, and hopefully we will answer your question next Thursday at 3.